this 3-part series with Gregory Care from Mallie Accounting and Services.
Our subject today is one that almost all of our sellers ask about: real estate and taxes, capital gains, and more. Does everybody at every party ask you about capital gains?
It comes up a lot.
I bet it does.
It comes up a lot.
I bet it does. Everyone thinks it applies to them.
Yeah.
Does it?
So with homeowners, with your primary residence, if you've owned it 2 out of the last 5 years and you own the home, you're eligible for a capital gain exclusion. So if you're single, it's $250,000. Married, it's $500,000.
And that's over and above. That's a net profit.
That's profit, not
Right.
the selling price. So that's a big confusion too.
Huge confusion,
Yeah.
right? So that's net profit. But then you said it's 2 out of 5 years. You have to live there, so 2 out of 5 years, even if it's been rented for the last 2.5 years of your 5 years, let's say.
Correct. And there could be some recapture there because you depreciated the property. So there is a piece that will be taxed because of recapture. But,
okay.
Yeah, so that sort of gets into the investment property rules too
Sure.
in your basis.
Sure, which is a whole other podcast, right?
Correct.
How about the repair costs? Aren't you able to deduct the repair costs from that, say, that $250,000 net or that $500,000 net?
Yeah, so the repairs and improvements to the property go into the cost basis. So,
so
prime example,
hypothetically,
you buy a home for $500,000, you put a roof into it, you redid the kitchen, you have $100,000 of improvements, and then so your basis is $600,000.
Okay.
You also include your selling cost when you sell the home, and then your settlement cost in purchasing the home too.
Okay, so
all
that goes
these
into it.
build into your cost basis, and then your gain is the differential between your selling price and your cost basis with your improvements.
Okay.
Give us a little hypothetical, a story maybe, that might help illustrate that.
Yeah, so I'll give you one of someone who, didn't do it within the 2 years, and they didn't really keep track of what they did to the property. So,
Okay.
They moved into a nice new home, could have been, let's just say, $1 million for the home.
Right.
And real estate's been crazy the past few
Yeah.
years. So,
That's true.
yeah, so they realized they didn't like, the area. They want to sell. They want to move back to the city. So, they didn't keep track of all the improvements they had. And with the way real estate's been, the value increased substantially within a year and a half,
Yep.
and they're selling under that 2-year period. So the gain is subject to capital gains tax at that point. You don't get the exclusion that, someone who lived in there for more than 2 years received.
Sure.
So they had to go back and really try and figure out what they spent money on and all the improvements to the house, because all that goes into the cost basis.
Okay. And then what does that look like? Like, what does a tax look like on somebody, in that scenario?
It depends on your taxable income. Will
Got
depend
it. Yeah, there's a
on
lot
how
of
much the
scenarios. Sure.
capital gain rate is. For most people, it's going to be either 15 or 20%.
Okay.
And it's only on the percentage over. It's not on the whole
Correct.
$500,000.
That's right.
Okay, so can you explain that a little bit? Because I think that's a very big
Yes.
point of confusion as well.
Yep. So the same scenario where they bought it for $500,000, $100,000 of improvements, and then let's say they then sell it for $1 million, and they were there for more than 2 years. Well, that's fully tax-free because their gain's only $400,000.
Right.
Assuming they're married.
Married couple.
Right.
Okay.
Correct.
Right. But is it taxed as income? Because I get that question a lot.
Yeah.
No,
It's not taxable income.
it's just pure profit.
Correct.
All right. Well, call us if you want to sell your house.
Yeah. Because market has gone up.
Yeah, some other situations too. I mean, you could be forced to move because of your employment. So
Right.
it's something you're not anticipating, and you're
Sure.
not keeping track of all your improvements to the property. So it is important to keep records of what you do to your property.
So
Absolutely.
with your clients, when you know that they buy a house like this and they're making improvements and obviously at tax time you're sitting down and they're saying, oh, is this tax deductible? Is this tax deductible? Do you help them keep track of their improvements? Is there a system?
I mean, everyone has their own system.
Sure.
So it's just making them aware of, it's a good practice to do. Just
Right.
because you're not sure if you're going to be there for more than 2 years,
Keep
and the
good
tax
files.
consequences. Tough when it's 4 years down the road too.
Yeah. No, for
dig
sure. I
up
think that's
everything.
important. Like Joy Marie and I, when we work with a new client, especially a client coming out of the area, and, for work, are you planning to be here? Like, what's your time frame as far as like 5-7 years, typically, which is the average for someone to be in their own home. But I think it's also important to say to them, look, if you plan to relocate, because people do tell us they job hop, and if they're going to be spending a lot of money and not putting a lot of improvements into their home, that might be something that they want to talk to their accountant about.
Yeah, another really good example that happens a lot is a lot of people like to rent out their first home after they move out.
Yes, huge.
I
I
mean,
get that
they
all the
don't-
time.
They don't realize what potentially, they could be missing out on if they rent their house out for the next 10 years, as far as, being able to access or tax-free cash from your primary residence.
Right.
Right.
If they can do it.
Correct.
That's the thing. If they can do it. But
If they can do it.
yeah.
Well, can you explain? I think not. You mean selling it instead of
Renting it.
Instead of renting
selling
it.
getting the cash back tax-free, and then make
Right.
your real estate
Got
investment.
it. Got
That's
it. Okay.
exactly right.
All
Yes.
right.
Yeah. I thought that there was a little bit of a. We were talking about two different things. Yeah.
Yeah.
So we were just in part one talking about a little bit of the investment property idea, which actually brought up when you were saying keep holding on to it. If you can,
Yeah.
you might find yourself in this 1031 cycle that we just talked about in part one, which you may not have thought you'd end up in, right?
If you take your primary residence and rent it out, and let's say you're out of the period for the capital gain exclusion, then yes, what
Yeah.
we talked about
Right.
last time.
You might
yeah,
find
it's-
yourself in a cycle you didn't expect to find yourself in. So that's something to discuss. But what are the capital gains implications on investment properties?
Yep. So it depends. So how investment properties work, when you depreciate the property, and you're depreciating real property, it's the depreciation on it's subject to a 25% recapture.
Okay.
Now, what some people do with commercial properties, they'll do a cost segregation study. They'll write off as much as they can of the property based on the study. And the study will break it out between personal property, real property at different depreciable lives, and then the rest is, potentially a 39-year life. The personal property subject to ordinary income recapture, the real property subject to 25%, and then everything else is capital gain.
And I'll tell you that we do this a lot, and how you just described it was in accounting speak, right? And so even though we know where you're
Talk to
going
me
with
like
this,
I'm in kindergarten.
100%. How can you, in any way you want, if you want to tell a story, explain that a little bit in a way that anybody could get it.
Yeah, so ultimately, when you depreciate the property, which is an annual deduction you get based on your cost basis into the property, if you sell the property, it's going to be subject to a different rate above capital gain rates.
Got it. So it
Okay.
could be even more.
Correct.
Okay.
Yeah.
That's got to be scary for some people, right?
Yeah, and that's where the 1031 becomes a little more favorable.
Exactly. And where you need to have your professionals around you.
Correct.
Helping you and advising you.
Yeah, that's definitely the takeaway, I think, from like all the, sessions we've done so far is just like have that yearly check-in with your accountant or your financial advisor and make sure that the path that you're on is still a good path. Because obviously, things change, income changes, tax brackets, all of that. So it could really make a difference.
Yeah, tax laws change.
Checking. Yeah,
Right.
tax laws
all
change.
the
All the
time.
time.
All the time.
Yeah.
And, I think that's one of the things that, again, we make sure to surround ourselves with people like you and Frank and Dave and,
Yep.
who's an attorney. And, of course, you know him. And making sure that we have those professionals around because we do real estate. We do it well, but you do accounting real well. And Frank
Yep.
does financial advising real well.
Yep.
And we need to make sure that they're getting the best advice. Our clients are getting the best advice.
Absolutely.
Thanks so much, Greg. Appreciate it.
Thank you. Thanks for having me.
If you're thinking about selling your home, call us first and we will put you in touch with Greg and we will get all of your questions answered. Thanks so much.